Are you worried about how the next economic downturn will affect your financial future? What if we told you that a recession could actually be an opportunity to increase your wealth? In this video, we'll share 7 practical steps to help you take advantage of the recession and come out financially stronger than before. From market timing strategies to diversifying your portfolio, we'll cover everything you need to know to make smart financial decisions during tough times. Our expert advice is backed up by real-world examples from successful investors, so you can trust that these strategies really work. So, if you're ready to learn how to turn a potential economic crisis into a financial opportunity, be sure to stick around until the end. Let's get started. Step 1. Understand central planning and the Federal Reserve. But first, what is central planning? Central planning is when the government makes decisions on how resources are allocated in the economy. This means that the government is in control of things like production, prices, and distribution of goods and services. In the United States, central planning is not as strict as it is in other countries, but the government still has significant control over the economy through policies and regulations. One of the key players in the U.S. economy is the Federal Reserve. The Federal Reserve is the central bank of the United States and is responsible for regulating monetary policy. Monetary policy refers to the actions taken by the Federal Reserve to influence the supply and demand of money in the economy.
Inflation results when supply and demand are out of whack. The Fed can't do anything to increase the supply of oil or to increase the number of houses for sale. The supply side is something out of their reach. But they can bring supply into balance by reducing demand.
The Federal Reserve uses a variety of tools to control the money supply, including setting interest rates, buying and selling government securities, and adjusting the reserve requirement for banks. One of the most important things to understand about the Federal Reserve is its predictability. The Federal Reserve follows a strict schedule of meetings throughout the year where they make decisions on monetary policy. These meetings are widely reported in the media, and the decisions made by the Federal Reserve are often anticipated by investors and economists alike. So, how can you use this knowledge to make smart investments during a recession? By understanding the role of the Federal Reserve and their predictable actions, you can make informed decisions about your investments. For example, if the Federal Reserve announces that they will be lowering interest rates, this could be a good time to invest in stocks or other assets that tend to perform well in a low interest rate environment. Step 2. Pay attention to interest rates. As you may know, interest rates play a significant role in the economy, and they can impact the stock market in a big way. In fact, there is a strong correlation between interest rates and the stock market. When interest rates rise, the stock market tends to fall, and vice versa. To better understand this correlation, let's take a look at a graph that shows the relationship between interest rates and the stock market over time. As you can see, when interest rates are low, the stock market tends to be bullish and perform well. But when interest rates start to rise, the market typically experiences a downturn or a recession. Now you might be wondering why rising interest rates lead to a market downturn. Well, the answer lies in the fact that higher interest rates can lead to a decrease in consumer and business spending, which can, in turn, lead to a slowdown in the economy. When the economy slows down, companies may start to experience reduced profits, leading to a decrease in stock prices. So, why is it important to pay attention to interest rates when timing the market? As we just discussed, interest rates tend to increase before a recession, so keeping an eye on interest rate movements can help you predict when a recession might be coming. This information can be incredibly valuable when deciding when to buy or sell stocks. Step 3. Follow the smart money. One example of a successful investor who has made a fortune timing the market is Bill Ackman. Ackman is a hedge fund manager and investor who is known for his savvy bets on market downturns. Ackman made a bold move in February 2020, just as the COVID-19 pandemic was starting to spread. He purchased credit default swaps that effectively bet against the corporate bond market, which he believed was overvalued and posed a significant risk in the event of a recession. His bet proved to be prescient, as the market crashed just weeks later and he made billions of dollars for his investors. To explain how Ackman's bet worked, let's look at credit default swaps. In simple terms, a credit default swap is like an insurance policy that pays out if a borrower defaults on their debt. If you believe that a company or market is going to decline, you can purchase credit default swaps to protect yourself against the risk of default. If the company does default, the value of your credit default swaps increases and you make money. So how can we apply this to our own investing strategy? Well, one lesson we can learn from Ackman is to pay attention to the actions of successful investors and follow the smart money. If someone like Ackman is making a bold move, it's worth considering whether they might be onto something. Of course, we can't simply copy their investments blindly. We need to do our own research and make informed decisions. But by paying attention to the moves of successful investors like Ackman, we can gain valuable insights into market trends and make more informed investment decisions. Step 4. Identify market trends. If you're thinking about investing your money, it's important to take a look at market trends first. Market trends are patterns in the way things like stocks, bonds, and commodities move over time. By paying attention to these trends, you can find potential investment opportunities and figure out the best time to invest or sell. In the past, some trends have had a big impact on investment returns. For example, in the late 1990s, tech stocks took off and caused the stock market to soar. But the dot-com bubble eventually burst, and many investors lost their money. Another trend that led to a significant impact on investment returns was the housing bubble that caused the 2008 financial crisis. To identify market trends, you need to keep an eye on things like inflation rates, GDP, interest rates, and unemployment rates. The stock market can also give you a good idea of how the economy is doing, so it's important to watch for any news or events that could impact the market's performance. One tip is to focus on long-term trends instead of short-term changes. While short-term trends can be helpful, they can also be influenced by market noise and be hard to predict. By looking at long-term trends, you can make better investment decisions based on fundamental economic factors. Are you ready to make $1 million from just starting with zero? Then hit that subscribe button and turn on the notifications for the steps of making your first $1 million and become financially independent. Step 5. Know when to buy and when to sell. Knowing when to buy and when to sell is crucial for maximizing your investment returns. It's not just about buying low, but also about buying at the right time. Timing is everything when it comes to investing. You want to make sure you are buying when the market is on an upward trend rather than when it's on a downward trend. By using technical analysis, you can make informed decisions about when to buy and sell. One way to identify a good time to buy is to use technical analysis. This involves analyzing charts and graphs of a stock's past performance to identify patterns and trends. Technical analysis can help you identify buy signals, such as when a stock's price breaks through a resistance level or when its moving average crosses above a certain threshold. In 2020, when the stock market crashed due to the COVID-19 pandemic, many investors were hesitant to buy stocks. However, those who followed the buy signal provided by technical analysis were able to make a profit. The buy signal was triggered when the S&P 500 crossed above its 200-day moving average, indicating a possible uptrend. Those who bought at this point were able to ride the upward trend and make a profit. Just like knowing when to buy, knowing when to sell is equally important. One of the biggest mistakes that many investors make is holding onto their investments for too long, which can lead to missed opportunities for profit or even losses. Listen to Warren Buffett.
I was always coming up with more ideas than I had money, so I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time I was in that mode. And now our problem is we have more money than ideas.
So, start to look out for the buy signals and put your exit strategy in place and stick to it. Step 6. Diversify your portfolio. Diversification is an essential tool for any investor, particularly in times of economic uncertainty. When you diversify your investments, you spread your money across different asset classes, such as stocks, bonds, and real estate, which helps to lower your overall risk. If one asset class performs poorly, others may perform well and help offset the losses. One way to diversify your portfolio is by investing in different asset classes like stocks, bonds, commodities, and real estate. This way, you're not putting all your eggs in one basket and are more likely to have some investments that perform well, even if others don't. Another way to diversify is by investing in different sectors of the economy, like healthcare, technology, finance, and consumer goods. By doing this, you're spreading your investments across a range of industries with different characteristics and performance histories, reducing your risk of losing money if one sector performs poorly. Lastly, it's also important to consider geographic diversification by investing in companies based in different regions of the world, helping to spread your investments across different economies. Warren Buffett, who is one of the most successful investors of all time, is a strong advocate of diversification. He has built a diversified portfolio that includes companies from different sectors, and he believes that diversification is a protection against ignorance.
The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs, because all they're going to do is own a part of America, and they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it.
So if you want to get richer, don't put all your money in one investment. Instead, spread your investments across different asset classes, sectors, and regions, and enjoy the benefits of diversification. Step 7. Stay disciplined. During a recession, staying disciplined is needed to achieve long-term success. The market can be unpredictable and volatile during a recession, leading to increased stress and emotions for investors. It is important to stay disciplined and stick to the plan, even when things become challenging. The temptation to make emotional decisions during a recession can be strong. Fear and panic may lead investors to sell their assets and flee the market, resulting in significant losses. On the other hand, investors may become overly optimistic and take on more risk than they can handle, leading to potential losses. There are several strategies for staying disciplined during a recession. One of the most effective is to develop and stick to a long-term plan. It would help if you determined your goals, risk tolerance, and investment timeline, and create a diversified portfolio that aligns with those factors. Sticking to your plan, even when the market is volatile, can help you avoid making emotional decisions. In short, a recession can be a great opportunity for savvy investors, but it's important to stay disciplined and diversify your portfolio. If you enjoyed this video, please consider subscribing to our channel for more informative content. Don't forget to hit the notification bell so you'll be the first to know when we release a new video. Thank you for watching and happy investing.